50. That's the number. Every 50 years, give or take, the same thing happens, and nobody sees it coming. Nobody. In 1873, the most advanced economy on Earth collapsed. In 1929, it happened again. In 2008, the world almost ended. Every single time, the same pattern. Every single time, everyone was surprised. And right now, in 2026, the pattern is back. Here is the problem. Total U.S. debt, government, corporate, and household combined, is now 360% of GDP. That number doesn't mean much until you know this. In 1929, it was 300%. In 2008, it was 370%. We are sitting at the same altitude as every major financial crisis in modern history. But here's what nobody is telling you. The debt itself is not the bomb. The debt is the fuel. The trigger is always something smaller. In 1929, it was a margin call. In 2008, it was a zip code in Florida. In 1873, it was a railway company in Vienna. Small spark, enormous fuel load. Same result. To understand why this keeps happening, you need to know one name. Nikolai Kondratieff, Russian economist, 1920s. He mapped 200 years of economic data and found something that got him sent to a Siberian prison camp because the Soviets didn't like what he found. He found cycles. Roughly every 40 to 60 years, capitalist economies go through the same four phases: spring, growth and expansion; summer, inflation and optimism; autumn, speculation and debt; winter, collapse and reset. We are, right now, deep in autumn. Asset prices inflated beyond any historical norm. Interest rates that went from 0 to 5% in 18 months, the fastest in 40 years. And a commercial real estate market sitting on $1.5 trillion in loans that need to refinance before 2027. That last one is the match factory. Let's run the comparison properly. 3 columns, 3 crises, same metrics. Column 1, debt to GDP at crisis peak. 1873, 160%. 1929, 300%. 2026, 360%. Trend accelerating. Column 2, interest rate increase in the 24 months before the crisis. 1873, rates doubled. 1929, rates rose 40%. 2026, rates rose 525 basis points. Fastest tightening cycle in 4 decades. Column 3, the trigger asset class. 1873, railroads, infrastructure overbuild on cheap credit. 1929, stocks, retail investors borrowing to buy equities. 2026, commercial real estate and private credit. Same story, different suit. Every column, same shape, different label. Now, here's the engineering part, because this isn't just history. This is systems theory. Complex systems fail when 3 conditions are met simultaneously. 1, high stored energy. Check. Debt at 360%. 2, reduced damping. Check. The Fed has less room to cut than in 2008. 3, external perturbation. We don't know what this is yet, but we never do. The 1873 perturbation was a bank. The 1929 perturbation was a margin desk. The 2008 perturbation was a mortgage bond. It is never the thing you are watching. It is always the thing you stopped watching. Now, before you close this video thinking it's doom content, let me tell you something the history books always skip. Every single one of these collapses produced the greatest wealth transfer in a generation. 1873 collapse created the Vanderbilt fortune. 1929 collapse built the foundations of the middle class. 2008 collapse made the private equity industry. The cycle doesn't just destroy, it redistributes. The question is not if the cycle turns. The question is which side of that transfer you end up on. So where exactly are we on the clock? Kondratieff Winter, the collapse phase, doesn't begin with a bang. It begins with liquidity. The first signal is always credit tightening at the edges. Small banks, small borrowers, places nobody is watching. We saw that begin in 2023 with regional bank failures. Silicon Valley Bank, Signature, First Republic. 3 banks in 3 weeks. The Fed called it contained. They called it contained in 1932. The second signal is asset prices divorcing from earnings. When price-to-earnings ratios go above 25 on the S&P 500 without matching earnings growth, history says correction is within 18 months. In early 2025, the Shiller PE ratio hit 37. The third signal, and this is the one to watch, is when the bond market stops believing the government. When 10-year Treasury yields rise even as the economy slows, that is the bond market saying, "We don't trust you to pay this back." Watch the 10-year yield, not the stock market, the 10-year yield. The debt collapse cycle is not a theory. It is a pattern, 200 years old, visible in the data of every major economy that ever existed. The math says, we are in autumn. The engineering says, 3 out of 3 collapse conditions are met. The history says, the trigger will be something small that nobody is watching. Kondratieff mapped this in the 1920s. They sent him to Siberia. The cycle happened anyway. Patterns don't care about politics. They don't care about central banks. They don't care about what we want to be true. If you understand the cycle, you are not a doomer. You are someone who finally read the manual. You are here. But here is not the whole story. Because sitting on top of this debt cycle, right now in 2026, is something Kondratieff never modeled. Something no economist in history ever had to account for. An information revolution happening at the same speed as the financial one. In 1450, a man named Gutenberg broke the gatekeepers of knowledge. It didn't feel dangerous at first. It just felt like cheaper books. We're in year 3 of ours. If you liked this content, please subscribe. See you in the next video.